Most businesses don't have a revenue problem. They have a liquidity timing problem. Revenue can be rising. Sales activity can be high. Pipelines can look healthy. And yet cash feels tight. Profitability does not guarantee stability. Growth does not guarantee control. If you're busy, but revenue isn't translating into financial strength, the issue is rarely effort. It's sequencing. And sequencing errors compound quietly. Founders and operators are particularly exposed to this. When you're building, scaling, hiring, selling, momentum becomes the metric. But cash flow discipline matters more than growth strategy, because growth amplifies structure. It doesn't fix it. If your timing is misaligned, growth accelerates instability. This affects agency owners expanding delivery teams, service firms adding account managers, operators committing to marketing retainers, CEOs locking into longer-term payroll structures. By the end of this video, you'll understand why being busy doesn't guarantee rising revenue, and more importantly, how financial timing determines operational stability. The most common interpretation when revenue plateaus or cash feels tight is simple. We just need more sales. It sounds logical. More sales equals more revenue. More revenue equals more cash. More cash equals stability. But that chain breaks in practice. Revenue is not the same as collected cash. Signed contracts are not cleared payments. Booked deals are not liquid capital. You can close a $100,000 contract. If payment terms are net 60, that revenue exists on paper, not in your bank account. Meanwhile, payroll runs every 2 weeks. Vendors expect payment. Marketing invoices arrive monthly. Commitments operate in real time. Revenue often converts later. That lag is where pressure forms, and the busier you are, the more you assume progress equals liquidity. It doesn't. Now layer growth decisions on top of that lag. You hire because pipeline looks strong. You expand marketing because sales velocity improved. You add software systems to professionalize operations. You commit to office space or upgraded infrastructure. You scale payroll to match projected delivery. Each decision is rational in isolation, but collectively, they increase fixed obligations. Then subtle tension signals begin to appear. You monitor receivables more closely. You delay a vendor payment by a few days. You hesitate before approving discretionary spend. You feel mild anxiety around payroll timing. Revenue hasn't collapsed, but liquidity feels unstable. Why? Because timing shifted. The structure expanded faster than cash converted, and growth exposed sequencing risk. There are 3 core cash flow risks that typically drive this instability. First, revenue is not liquidity. Revenue is an accounting measure. Liquidity is a timing measure. Revenue reflects what was earned. Liquidity reflects what is available now. When founders manage the business through revenue reports alone, they miss the timing dimension. Cash flow discipline requires tracking conversion cycles. How long revenue takes to become usable capital? If conversion lengthens even slightly, liquidity compresses immediately. Second, fixed cost sensitivity. Fixed costs reduce flexibility. Payroll, long-term contracts, retainers, subscriptions, they create non-negotiable outflows. When fixed commitments grow faster than cash conversion speed, the business becomes sensitive to minor disruptions. A single delayed client payment can create disproportionate pressure. The issue isn't lack of sales, it's lack of buffer. Third, decision timing exposure. Every growth decision assumes continuity. Continuity of collections, continuity of demand, continuity of performance. But timing rarely behaves perfectly. When commitments are made before cash stabilizes, you create exposure. That exposure is invisible during strong months. It becomes obvious during slight delays. Cash flow discipline means sequencing decisions after cash proves durability, not before. Let's model this numerically. Assume a service business generating $200,000 in monthly revenue. Payment terms are net 30. On average, collections occur in 35 days. Fixed monthly commitments, $80,000 payroll, $25,000 marketing, $15,000 software and systems, $20,000 operating overhead. Total fixed obligations, $140,000 per month. At face value, revenue exceeds commitments by $60,000. It appears stable. Now introduce a minor delay. Two large clients, totaling $60,000, pay 20 days late. Collections drop temporarily to $140,000 for that month. Outflows remain $140,000. Buffer disappears instantly. If one additional expense emerges, a bonus, equipment purchase, tax payment, liquidity compresses further. Revenue hasn't declined. Demand hasn't collapsed. But timing shifted. And because fixed costs were scaled to expected collections, not stress-tested collections, pressure forms quickly. Now imagine this pattern repeating twice per year. You remain profitable annually, but liquidity feels unstable quarterly. That instability shapes behavior. You hesitate, you defer, you operate defensively. Not because revenue is weak, because sequencing was fragile. Liquidity control requires structural thinking. 3 principles govern this. Principle 1. Separate revenue from cash metrics. Track revenue growth separately from cash conversion speed. Measure days sales outstanding. Measure cash runway independent of booked deals. If revenue grows but conversion slows, discipline decisions accordingly. Principle 2. Sequence commitments after cash conversion. Do not scale fixed costs based on projected revenue. Scale based on demonstrated cash stability. If new payroll depends on flawless collections, delay expansion until variability is absorbed. Principle 3. Stress test fixed cost expansion. Before increasing recurring commitments, model a 15 to 20% collection delay. If the structure cannot withstand it without anxiety, it is overextended. Disciplined growth prioritizes resilience over speed. Liquidity control preserves optionality. If sequencing remains misaligned long-term, fragility compounds. You begin relying on credit lines. You make reactive decisions. You prioritize short-term cash over strategic positioning. Founder stress increases. Opportunities are missed because liquidity is constrained. Control erodes gradually, and growth becomes heavier, not stronger. Optionality declines. Revenue fuels growth. Liquidity protects survival. Busy does not equal stable. Activity does not equal strength. If you value structured breakdowns like this focused on financial control and operational stability, subscribe for more strategic insights.